All right, let's pull back the curtain on one of the most powerful, yet, let's be honest, least understood institutions in the entire world, the Federal Reserve.
So who's really pulling the strings of the U.S. economy? It's a huge question, right? And look, while there are a ton of forces at play, a massive chunk of that power belongs to an institution created over 100 years ago to wrangle financial chaos. You know it as the Federal Reserve, or more simply, the Fed.
So to really wrap our heads around why the Fed even exists, you got to go back in time with me. Let's take a look at what America's financial system was like before the Fed. And believe me, it was basically the Wild West of banking.
Just look at this timeline. From the mid-1800s all the way to the early 1900s, the U.S. economy was just constantly getting rocked by these devastating financial panics. And we're not talking about little bumps in the road here. No, these were absolutely crippling crises that just wiped out businesses, wiped out fortunes. It all came to a head with that huge crash in 1907. So what was the core problem? Well, see, back then, individual banks could issue their own money, their own banknotes, but they often printed way too much of it compared to the actual gold or silver they had locked away. So you can imagine, right? The slightest hint of an economic downturn could trigger a massive panic. Everyone would rush to the bank at once, trying to trade their paper money for real coins. And to get that cash, the banks would turn around and call in their loans from businesses, demanding immediate repayment. It was a domino effect that led to bankruptcy after bankruptcy.
This whole era was known as free banking, and it was just total chaos. I mean, it led to some pretty bold scams, like these so-called wildcat banks. Here's how it worked. A con artist would set up a bank way out in the middle of nowhere, where only the wildcats roam. They'd print a ton of worthless banknotes, and then just vanish with all the real money, leaving everyday people holding literally useless paper.
You can imagine the public's trust was at an all-time low. So low, in fact, that paper money earned some, let's just say, colorful nicknames. I mean, when people are calling your money shin plasters and cow chips, you know you've got a serious problem. The whole country was just desperate for something to change. Okay, so after that huge panic of 1907, Congress finally came up with a solution. And that solution was the Federal Reserve Act of 1913. This was basically the blueprint for the Fed as we know it today.
So to fix all that chaos we were just talking about, this act had 4 big goals. First, create a money supply that could actually flex with the economy. Second, act as a lender of last resort when banks got into trouble. Third, make the payment system work efficiently across the country. And fourth, actually supervise the banks.
Now, one thing to remember is that Americans back then were really suspicious of centralized power. So the Fed was designed as a compromise. As you can see on this map, instead of having just one big central bank in Washington, they split the system into 12 regional districts, each with its own bank. The idea was to spread that power out.
Okay, I know this chart looks a little complicated at first glance, but don't worry. The whole power structure of the Fed really just boils down to 3 key parts. They all work together to set the country's economic policy.
All right, so you've got the Board of Governors, they're in D.C., and they're kind of like the strategists setting the big picture. Then you have the 12 district banks. They're the boots on the ground, the ones doing the day-to-day work. But the part that really moves the needle for the economy, that's the Federal Open Market Committee, or the FOMC. It's made up of some of those governors and a few of the bank presidents, and these are the folks who make the huge decisions about our money supply. So, the big question is, how does this whole system actually steer the massive U.S. economy? Well, it really comes down to 3 main tools that the Fed has in its toolbox. Yeah. You can really think of these as the 3 main levers the Fed can pull. With these, it can either inject money into the economy to get things moving faster, or it can pull money out to cool things down. Okay, so out of the 3, by far the most important one is what's called open market operations. This is the Fed's day-in, day-out workhorse. Essentially, the trading desk at the New York Fed is constantly buying and selling government securities. When they buy securities, they're putting money into the banking system. When they sell them, they're taking money out. It's how they literally fine-tune the economy every single day. Here's a good way to think about it. Those open market operations are like the daily tweaks, the really subtle adjustments. But changing the other 2, the discount rate or the reserve requirements, whoa. That's like the Fed grabbing a giant megaphone and shouting a major announcement to the entire financial world. It sends a huge signal. Okay, so we've talked about committees and tools and all this technical stuff. But here's the most important part. Why should you even care? Well, it's because these decisions have a very real impact on your wallet.
Look, every single time that FOMC committee decides to raise or lower interest rates, it sends a ripple effect across the entire economy. That decision directly affects the interest rate you pay on your mortgage, on your car loan, even on your credit cards. It can even influence whether companies in your town are hiring or laying people off. And get this is the kicker. The Fed makes an incredible amount of money. We're talking around $30 billion a year. So much, in fact, that it doesn't need a single dime of funding from Congress. Now, that independence is what lets it make really tough decisions without political pressure. But it also creates this really fascinating question, right? You have this incredibly powerful, unelected group of people steering the economy inside of a democracy.
And all of that immense power, it leaves us with one final and really crucial question. If the Fed has this much control over our economy, who holds the Fed accountable? It's a debate that really gets to the very heart of how our entire economic system works.